Welcome back to another video, everyone. In this video, we are going to cover gaps. So I'm going to break down what are gaps, why do gaps happen, types of gaps, gap fills, and gap examples. So I'm going to break everything you need to know about gaps and get a solid understanding about why they happen, how to actually trade them, what they are, and the different type of gaps. So let's get started. So what are gaps? So as you guys can see here, this is what a gap looks like. And gaps are basically sharp breaks in price that are created when the market closes after a day of trading and then reopens at a different price. Stocks can gap up or gap down. They can gap both directions. So in this situation, the stock gapped up, right? This is basically a gap. There's no trading activity here during normal market hours. The trading activity that happened here has happened in pre-market or after hours. So for example, what is a gap up? So let's say this is Tuesday, and let's say the next day is Wednesday, right? Tuesday, the stock closed at, let's say it's a green candle, right? So if it's green, it opened here, it's at 10, closed at 11, that's why it's green. The next day, for it to gap up, the stock would have to open above 11. Open meaning the first transaction at 9:30 a.m. Eastern Standard Time, right? When the market opens, the first transaction would have to happen at or above 11. Not at 11, I'm sorry, above 11. So let's say 11:50. Let's say 12. Let's say 13. Whatever number above 11 will be considered a gap up. And it would look something like this. There's no trading activity during normal market hours at this point. That's why there's a gap up. A gap down would be the opposite. Let's say Wednesday, let's make it a green candle as well, right? Let's say stock opened at 10, closed at 12. Remember, this is the wick. This represents the lowest point. That's $9, let's say. The next day, Thursday, the stock would have to open below what number? What number do you think the stock would have to open below for it to gap down? The stock would have to open below yesterday's closing price. So yesterday's closing price was 12. So if it opened at, let's say, anywhere below 12, let's say even if it opened at 9, right? Even if it opened up here, that's a gap down. Even if it opened up at 8, it's a gap down. The stock has gapped down and it looks something like this, right? You can see no trading activity. This is a daily chart, by the way. Each candle represents one day. So the gap down here represents that during this period, there was no trading activity happened during normal market hours when the market was open. And this, once again, represents a gap down. Now, the question people have is, why do gaps happen? What causes gaps? So stocks gap up or gap down at times because of price fluctuations in pre-market, right? Or after hours. So stocks gap up or gap down at times because of price fluctuations in pre-market or after hours. For example, the price fluctuations happen because of catalysts such as earnings, economic data, or any news related to the company. Any of these three causes a stock to, at times, either gap up or gap down. There are times where the stocks do gap up or down without any news or any set of catalysts. That's where it kind of gets a little tricky. I'll get into that. I'll get into what gap that is. We're not really fans of trading that. We want to trade stuff that has a solid reason on why it gapped up. When I have some catalyst of a stock gapping up or gapping down, those are going to give us high probability in real trades. So for example, let's look at Roku. So stock Roku, you can see we're looking at Roku right here. Roku in this situation gapped up, right? Roku gapped up because of earnings beat. So Roku had earnings, you guys can see right there. Their earnings were good, right? Good earnings, good forward guidance, everything was good. Because of that, the stock gapped up. You can see there's catalyst. There is some sort of event or news here that's causing the stock to gap up. That's causing the stock to make a move up, right? Because of catalysts, because of news. Now, the reason there's no trading activity here, or looks like there's no trading activity, is because we are on a daily chart. The trading activity that happened here happened pre-market, before the market opened, or after hours the day before, right? And because of that, all the trading activity maybe led to a higher price point, which is now causing a gap up. Now, all the trading activity that happened here, I'll show you where it happened. So you can see where the stock opened and where it closed, right? Now, if I go to an intraday chart, this is a 5-minute chart. This was the day they had earnings. You can see Roku has earnings. This is where it closed, right? Closed around 100 bucks. Has earnings, trades after hours, after hours, after hours. The next day, pre-market. Remember, pre-market is before the market opens. After hours is when the market is closed. Stock gaps up, starts trading higher after hours. The next day, pre-market, it's also moving higher and higher. And then as it's moving higher, the first transaction that happens here. This is the first transaction. This is yesterday's last transaction. Because of that, there is now a gap. There was trading activity, but the trading activity cannot be seen on a daily time frame. It can be seen on an intraday time period, and you can see how the stock starts moving, right? Now, how do gaps help us? We understand what a gap is. We know there's up gaps, down gaps. How do gaps help us? So gaps give us an idea of sentiment, bearish sentiment, bullish sentiment. When a stock basically gaps up, right? When a stock gaps up, there's a high possibility that it may keep going higher. Now, hold on. Keep this in mind. There's a high possibility it may keep going higher, but it all depends on the gap and the reason behind it. Just because a stock gapped up doesn't mean it's always going to go higher. There's gap strategies that we're going to cover and things to look for moving forward. But what I want you to understand is when a stock does gap up, yes, there is a higher possibility it's going to keep continuing and keep going higher. But it depends on the gap type and the reason behind it. A lot of people overlook this. They think just because a stock is gapping up, it's going to keep going higher all the time. No, sometimes the stock gaps up and starts selling off. Next, when a stock gaps down, there's a high possibility that it may keep going lower, right? That also depends on the gap and the reason behind it. Just because a stock is gapping a certain direction doesn't mean it's going to continue that. It needs to have a solid reason behind it and depends on the reason. So if this is a stock, let's say this is Monday and Tuesday, it gaps, right? And there's, let's say, a gap here. It doesn't mean it's always going to keep going down. It could gap down, right? The stock can gap down, open lower, and then keep going higher. So you need to understand it depends on the gap and the reason behind it. Gap levels also work great for support and resistance levels. So for example, if let's say a stock gaps up, I'll break that point down. Let's say this is a stock and it gaps up. These gap points automatically become our strong critical levels, and you're going to see what I mean by that. And then finally, gaps at times help us with great trading opportunities. I personally love trading gaps depending on what gap it is and why it gapped up or down. And once we go over different strategies, I'll show you the strategies I play and what I look for and how I actually play them. So gaps at times, once again, at times, not every gap, do provide great trading opportunities and very high probability setups. Now, what are the type of gaps? There's 4 types of gaps, right? First is a common gap. Second, we have a continuation gap. Third, we have an exhaustion gap. Fourth, we have a breakaway gap. So I'm going to break down all 4 types of gaps. So these are the 4 gaps, and I'm going to break them down and let's understand them. The first one is a common gap, right? A common gap is nothing extraordinary because it can happen frequently without any major implications about further price movements. This gap usually doesn't provide any trading opportunities. This is the gap I was talking about. This is where a lot of people mess up. Just because a stock gaps up doesn't always mean there's a play. Just because a stock gaps down doesn't mean there's always a play either. These gaps are very common. These happen at times without any major reason. There's no major reason behind certain stocks, and there's stocks you guys are going to see on when you look at your charts. They're gapping up, they're gapping down every other day, and a lot of people try to play those gaps, but remember, most of the times there's no gap. You can see here, stock gaps up, sells off, goes up, gaps down, gaps up. It's like all over the place. It's too messy. There's no real direction, no real play. So when you see a common gap, or when you see a stock trading sideways, gapping up or down, don't try to play that gap play because there's no gap play there at all. If you guys look over here on the common gap, you can see a lot of common gaps. This is for stock Amazon. Amazon, you guys are going to see, has a lot of gaps. You can see gaps, right? Gaps, multiple gaps, multiple gaps. These are all common gaps. You can see it's trading sideways, no clear direction. Even here, no clear direction. It's gapping multiple times. When you see this happening to a stock, just understand that this is a common gap and there's no plays here. A lot of people misunderstand that. They trade the common gap and they think it should have a play, but at times it doesn't, and it shouldn't. It's a common gap. It doesn't really have any plays. It doesn't really have any reasons on gapping up or down. When you see this, avoid trading common gaps. There's no play in common gaps. Next, we have a continuation gap. This is a good gap. This is a gap you can trade. What's a continuation gap? Continuation gaps happen in the middle of trends. A gap upward signals a continuation and that additional buyers have entered the market. So for example, stock is going on an uptrend. You see a gap. This is known as a continuation gap. This gap is continuing its direction. This can happen on the upside or the downside. You can see a stock gap on a downtrend, consolidating and gapping down. That could be a continuation gap on the downside. This is a continuation gap on the upside. Now let's break down price action. Stock makes a healthy move up, healthy uptrend, takes a break, very healthy move, healthy break, and then continuation gap, which is strong play. And then you can see, boom, another continuation right there. So continuation gaps are pretty phenomenal, pretty good. Once again, we want to see catalyst. We want to see something behind it. If there's catalyst behind this and why it gapped up or why something gapped down, very, very important to look for. Continuation gap right here. You can see stock Apple, right? It's going on a slow, healthy uptrend. Gaps up because of earnings, and you can see continues that gap, right? Continues that move up, sorry. Once again, stock Apple makes a healthy move up, right? Pretty healthy. Boom, gap. Why did Apple gap? Earnings. And like I said before, gaps work as great levels of support and critical levels basically. And that's where gap fills kick in, which I'm going to break down in a bit. Next, we have exhaustion gaps. What are exhaustion gaps? Exhaustion gaps usually happen during the ending period of a trend and can signal a potential reversal. Price makes one final gap in the direction of the trend and then reverses. So exhaustion gaps are when a stock is, let's say, going on an uptrend and it has a gap like this. Now, if you understand price action, which you guys should by now, you should get a solid idea of it. When you see a candle like that with a gap, that's already like, whoa, what's going on? There's a difference of seeing a candle like that, and there's a difference of seeing a gap up candle looking maybe like that. That's a strong candle, right? But when you see a candle like that and it gapped up, you should be able to identify, wait, this is an exhaustion gap. Stock is exhausted. That up move is probably going to die out. It's probably going to reverse. And once again, wait for confirmation. Without confirmation, we don't take the trade. And you can see what happens. It gaps up. Candle showcases it's exhausted, right? And you can see what happens to the stock. Exhaustion gap right there too. Stock goes up. Nice healthy move up. Stock Apple, right? Gaps up because of earnings. Gets rejected at a critical level. We have a critical level here for Apple, around 215. You can see the candle gets rejected, and you can see what happens. Obviously, there was, for people that have been trading Apple or have been trading for a while, you understand that here there was market news and market sentiment that caused that, but that exhaustion gap with the candle formation right here is kind of helping our play much, much better. Finally, we have a breakaway gap. A breakaway gap is when the price gaps over resistance or below support. This gap usually signals a trend formation. I love breakaway gaps. Very, very, very great gaps. So in this situation, you can see resistance, resistance, right? Stock's having a hard time breaking this point. What happens one day? Stock gaps up. It gaps up above that level. That is known as a breakaway gap. When a breakaway gap happens, usually it does signal a trend continuation, or it signals a new trend forming, right? So once again, you can see critical level, resistance, stock gaps up, signals a new trend is now forming. Very, very healthy move right here, right? Now, another thing I want you to understand is this does not just randomly happen. If it does randomly happen, I'm not trading this, right? I want a reason. Why did this gap up? Okay, there was earnings, there was an upgrade, there was catalyst, something that showcases that this is gapping up for a solid reason. I want that before I actually take on the trade, right? Now, next, if you look here, breakaway gap, stock Disney, resistance area, resistance area, resistance area, resistance area, multiple times, resistance, resistance, over and over and over again, right? Same thing here, nice healthy uptrend, going into resistance, we're not buyers, and look, news came out this day. For anyone that's been trading Disney or understands around this point, you know what news came out. I'm not going to jump into that for now, but you can see strong catalyst, strong news, gap up right above resistance point, breakaway gap, and you can see solid healthy uptrend. Very, very strong play right there. So those are the 4 type of gaps. Distinguishing and understanding the difference between them, especially when you see them on a stock chart, is very, very important, especially knowing when to trade them and when to leave them alone. Next, we have gap fills. What is a gap fill? So a gap fill is basically filling the gap, which means that prices return to the level where the stock gapped from. So in this situation, you can see stock gaps down, and what happens? It fills that gap area. So a lot of people get these gap fills wrong and don't understand them the right way and lose a lot of money trying to trade gap fills, right? So I'm going to break down the proper way of trading them and understanding them. Now, what you have to understand about gap fills, if it's a breakaway gap, it probably won't be filled, at least not in the near future. If it's a common or runaway gap, it might get filled or it might not, right? So it depends on the gap type. So gap fills, depending on what gap's going to get filled, it always depends on the gap type. Right? Depending on the gap type, you can analyze which one has a probability of getting filled and which one doesn't. A lot of people, I know, try to always trade gap fills thinking every gap is going to fill. Every gap is not going to fill, right? Some gaps will fill, but not every single gap. You need to understand that. You need to look at other indicators such as momentum to confirm whether a price move is at risk of going backward to fill a gap, right? So for example, let's say this stock gaps up because a company announces increased outlook on earnings, or they're growing and they're maybe partnering up with another firm or another company, whatever the case is. And there's a lot of volume, the stock keeps going higher. There's a very low chance this is going to get filled, right? Depending on price action, depending on volume and all those things. So these things have to be looked at to understand, will this get filled or will it not get filled, right? Especially for that current time period. Maybe in a year, maybe 2 years, probably may get filled, but sometimes some gaps never get filled, right? So for example, this is a gap fill. You can see Bank of America, stock gaps up, solid earnings. Like I said, that gap area always works as a strong level of support. Support, 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 right? It breaks that point, right? And what does it do right here? It fills that gap. Usually when stocks fill the gap, and once we go over the strategies, I'll show you how to play gap fills the proper way. When a stock fills a gap, there is a probability it fills it and then continues, or sometimes it may fill the gap and continue, right? Knowing how to play that, we'll get into it, but I just want you to understand when there's a gap, at times, not all the time, it may probably get filled. So going over this trade real quick, just so you understand, we know that there's support, 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 support. The moment the stock breaks that support area and goes below it on strong volume on an intraday level, because this is a yearly chart, so we're trading it on an intraday level, like a 5 minute, 1 minute, 15 minute. The moment it breaks that level, we can probably take on a short position and look to take profit here, put our stop loss there. That would be a good, phenomenal trade. If it fills, great, you had a solid trade. If it doesn't fill, not a solid trade, right? Trade didn't work out. Now, all gaps are not created equally. Just because you see a gap, and I've mentioned this multiple times, just because you see a gap does not mean it is the same. All gaps are different. As you can see, not all gaps are created equal, and therefore, a generalization like all gaps need to be filled is not something we should pay mind to. Let's get rid of this thinking that all gaps need to get filled, because all gaps don't need to get filled, and all gaps do not get filled. Instead, we ask ourselves the questions. What type of gap is this? Why did the stock gap up or down? And how does this gap fit within the context, which is the most important thing, of the rest of our evidence? Very, very important to ask yourself these three questions. What type of gap is it? Is it a common gap, breakaway gap? What type of gap is it? Why did the stock gap up or down? And how does it fit within the context of the rest of our evidence? Now, the context meaning, is a stock gapping up? Let's say a stock gaps up, right? And it gaps up right to our resistance point. Am I buying? Not really. I'd want it to kind of break my resistance point. Now, if the stock gaps up into my resistance point and I see a strong rejection, and it's not a strong move up, possibly short, right? So understanding that context is very important. Also, let's say a stock does gap up, and worst case worst, just throwing out a scenario, we go into war. Let's say Trump announces that, hey, we're going into war with this country or that country, whatever the case is. Would I trade this? No, I'm not looking to be a buyer. I'm looking for shorting opportunities. I'm not looking to buy this because the market is probably going to sell off. These are other things we're going to cover to put more pieces together, but I'm just giving you the context and understanding when to take on a trade and when not to take on a trade. Now, if you guys take a look right here, you can see stock Apple, 5-year daily chart, gap. Does the gap ever get filled? No. Breakaway gap, right? You can see stock goes on a healthy uptrend and never ever comes back to this level ever again, right? Now, that's where a lot of people mess up. They're like, oh, it gapped up, oh, it gapped down, it needs to get filled. Don't focus too much on it, right? Can it fill? Yes, it can fill. If the stock does get back to this point, I would obviously watch that for a support level, and then I would watch for the gap fill. But right now, not something I am focused on. You can see, for the people that were stuck on this gap fill, stock was at 130, and then ran all the way to 233. Like, oh, it's gonna fill, oh, it's gonna fill. No, it doesn't have to always fill. Just to recap, there's different type of gaps. You need to understand which gap is presented in front of you when you're trading them. Not all gaps are filled, right? And just understanding the reason the stock gapped up, the reason the stock gapped down, understanding the context is what we're gonna use to actually trade gaps moving forward. In the upcoming lessons, there is a lesson I have that goes over how to trade gaps, which I will break down and show you different examples. But for now, I just want you to understand and analyze different type of gaps, and then we'll start putting more and more pieces together.